Hi there and welcome. My name is Corey. I am with Tax and Noted. So welcome or welcome back. I just wanted to make a video today to stay consistent and to also just see if you had a chance to check out my video from last week. I did do a recap from the tax convention that I went to. It was with SmartWiz. That's the company that I'm working with. It was located in Birmingham, Alabama. And so I got to meet a lot of the people that I have been working with over the last several months, got to put some faces with the names. We broke bread together, learned about the latest tax laws and strategies and social media. We did interviews and had an award ceremony. It was just awesome. The next one's supposed to be in September, so we don't have to wait for a full year. And so it's awesome. I'm looking forward to it. So today I just want to talk to you about the top 5 mistakes that are commonly made when people file their taxes and how to avoid them. So let's get into it. Mistake number 1 is filing late. So the IRS will assess a failure to file penalty when a tax return is not filed by the due date or by the date of an extension. Not paying the balance by the deadline is subject to interest and a monthly late fee. So you should file on time even if you can't pay the balance in full, although it is in your best interest to pay in full as soon as possible to minimize additional interest charges. So if needed, the IRS does have payment plans if you end up owing. Mistake number 2 is forgetting to report all of the income earned during the year. So wait until you get all of your income statements before you file. Otherwise, you may have to file an amended return. Also, carefully review all of the income documents for errors. So if you see anything missing or inaccurate information, contact that payer right away. Mistake number 3 is overlooking credits and deductions. A credit is an amount that you can subtract from the taxes you owe. This can lower your tax payment and even increase your refund. So some credits are refundable, meaning they can give you a refund back even if you don't owe any money, and we love that. So types of credits include the earned income credit, the child tax credit, dependent care credit, higher education credit for our college students, savers credit, which is for when you are putting money into an IRA or your employee-sponsored retirement plan. Also, the residential energy credit. So if you installed solar panels or energy efficient windows, also credits for an electric vehicle, plus many, many more. Now, let's talk about deductions. A deduction is an amount you can subtract from your income when you file so you don't have to pay tax on it. By lowering your income, deductions lower your tax liability. So we have what's called the standard deduction versus the itemized deduction. Most people take the standard deduction, which lets you subtract a certain amount from your income based on your filing status. So we will discuss the different types of filing statuses a little bit later on in the video. So if your deductible expenses and losses are more than the standard deduction, you can save money by deducting the expenses one by one from your income. This is called itemizing. So types of deductions include the following: alimony payments, business use of your car, an exclusive home office, money that you put into an HSA account, student loan interest, teacher expenses, moving expenses for our military service members. Mistake number 4 is filing under the wrong filing status. So a taxpayer's filing status depends on whether they are married or unmarried on December 31st the previous year, which determines the filing status for the entire year. The filing status determines how much tax you owe, if you can claim certain tax credits, your standard deduction amount, and whether you get a refund. So there are 5 filing status categories. There's single, which is unmarried, divorced, or legally separated. Married, filing jointly, which is pretty self-explanatory. We also have married filing separately. They want to be responsible for their own taxes. However, it's in most cases, it's most beneficial for the couples to save money by filing jointly. We have head of household, which is for a single person who has paid more than half of their living expenses for themselves and a qualifying dependent. And then lastly, we have the qualified surviving spouse. So if your spouse died during the past 2 years and you have a dependent child, you can claim this filing status. Mistake number 5 is not seeking professional help. A tax professional can help eliminate errors, ensure your returns are prepared correctly, especially on complicated situations like the self-employed or if you have multiple streams of income. Now, working with a tax professional can offer you specialized knowledge and assistance with navigating complex tax regulations. They work to minimize tax, maximize tax returns, and safeguard your wealth. So guys, that's all for now. Thank you so much for watching. Don't forget to like, share, and subscribe for more tax tips. So leave me a comment below if you have any questions or if you would like a free quote. Until next time, stay organized, stay informed, and stay blessed.